Are you interested in the financial markets but not sure where to start? Struggling with understanding the different instruments available? You're in the right place. In this video, we'll take a deep dive into the world of financial instruments and explore some of the most popular instruments traded in the financial markets, including stocks, Forex, commodities, cryptocurrencies, and indices. Understanding these instruments and how they work will help you make informed investment decisions, manage your investment risks, and potentially lead to profitable trading experiences. So sit tight and get ready to expand your knowledge on the world of financial instruments. First, stocks. Stocks are a type of financial instrument that represents ownership in a company. When an individual buys a stock, they are purchasing a small part of the company and become a shareholder. Shareholders have the right to vote on certain company issues, such as electing board members, and are entitled to a portion of the company's profits in the form of dividends. Then, here is the feature of stocks. First, high potential returns. Stocks are notoriously known for their volatility in the short term, but over the long term, stocks have historically produced higher returns than other asset types. Over the past 100 years, the average annual return of the stock market has been around 10%. Second, risk. With the potential for high returns comes higher risk. The value of a stock is subject to market fluctuations, economic conditions, and company-specific events, and investors may lose part or all of their investment in the stock. Third, liquidity. Stocks are commonly traded on public stock exchanges and are relatively easy to buy and sell, making them a highly liquid asset. Last, diversification. Stocks can be a great way to diversify a portfolio of investments. By investing in a variety of stocks across different sectors, industries, and regions, investors can help reduce the overall risk of their portfolio. In summary, stocks represent ownership in a company and offer high potential returns, but also come with higher risk. They are highly liquid and can provide diversification benefits to a portfolio. Then, Forex. As we discussed Forex in our previous video, in this new video, we will introduce and delve deeper into the concept of currency pairs. A currency pair is the quotation of two different currencies that determine the exchange rate between them. Currency pairs are traded in the Forex market and are the basis of Forex trading. The most popular currency pairs are the major currency pairs, which include euro/dollar, pound/dollar, dollar/yen, dollar/Swiss franc, Aussie/dollar, dollar/Canadian dollar. There are also minor currency pairs and exotic currency pairs. Minor currency pairs are currency pairs that are not frequently traded in the foreign exchange market. They include currency pairs that do not involve the US dollar as one of the currencies, such as euro/pound, Australian dollar/Canadian dollar, New Zealand dollar/Japanese yen. Exotic currency pairs are currency pairs that involve one major currency and one currency from an emerging or smaller economy, such as US dollar/Swedish krona, US dollar/South African rand, US dollar/Brazilian real. Next, the feature of currency pairs. Currency pairs have two features. One is that they allow traders to speculate on the price movements of one currency against another currency. For example, if a trader believes that the euro will appreciate against the US dollar, they can buy the euro/dollar currency pair, and if the euro does appreciate, the trader will make a profit. Another feature of currency pairs is that they represent the relative strength of one country's economy versus another's. The exchange rate of a currency pair can be affected by a wide range of factors, including economic data, political events, and market sentiment. Next, commodities. Commodities are raw materials or primary agricultural products that can be traded, such as gold, silver, crude oil, natural gas, corn, wheat, coffee, and sugar. The commodity market is a global market where these commodities are bought and sold. The most notable feature of commodities is that they are tangible assets with intrinsic value based on supply and demand. For example, crude oil has value because it can be refined into gasoline and other products that people depend on for transportation and other purposes. Another feature of the commodity market is that it is affected by global economic and geopolitical events. Natural disasters, political instability, and changes in supply and demand can all affect the price of commodities. The commodity market also features futures contracts, which are agreements to buy or sell a commodity at a specific price and date in the future. Futures contracts allow traders to hedge against price fluctuations and can also be used for speculative purposes. Finally, many traders are attracted to commodities because they offer diversification benefits to their portfolio. Commodities have a relatively low correlation with other financial assets, such as stocks and bonds, which means that they can help to reduce overall portfolio risk and volatility. Next part, cryptocurrency. Cryptocurrency is a digital asset that is designed to work as a medium of exchange using cryptography to secure transactions and to control the creation of new units. The most well-known cryptocurrency is Bitcoin, but there are now thousands of other cryptocurrencies in circulation. The most notable feature of cryptocurrencies is their decentralized nature. Unlike traditional currencies, which are controlled by central authorities such as governments or banks, cryptocurrencies operate on a distributed ledger called the blockchain. This means that no single entity can control or manipulate the supply of the currency. Another feature of cryptocurrencies is their transparency. Because transactions are recorded on the blockchain, they are visible to everyone who uses the currency. This allows for greater accountability and reduces the risk of fraud. Cryptocurrencies are also highly volatile, which means that their value can fluctuate rapidly. This is due to a variety of factors, such as changes in demand, regulatory developments, and market sentiment. In addition, cryptocurrencies have gained popularity due to their anonymity and the fact that they can be used for transactions without the involvement of banks. However, this has also led to concerns about the potential for illegal activities, such as money laundering and terrorist financing. Now, we come to the last part, indices. Unlike other instruments, indices generally do not belong to a particular asset class or category like stocks, bonds, or commodities. Instead, an index represents a measurement of the performance of a group of securities, typically stocks. However, some indices may be specific to certain sectors, regions, or industries. For example, the S&P 500 tracks the performance of 500 large-cap U.S. stocks, while the Composite Index tracks the performance of technology and growth companies listed on the Nasdaq Stock Exchange. The Dow Jones Industrial Average, DJIA, tracks the performance of 30 major U.S. companies across various industries, while the FTSE 100 is an index of the 100 largest listed companies on the London Stock Exchange. Even though indices are not classified as an asset class themselves, they can be used as a tool for investing in different asset classes. For example, an investor can use indices to invest in stocks by purchasing an index fund that tracks the performance of a specific index. Indices can also be used as benchmarks to compare the performance of a particular investment against the broader market. In conclusion, we have explored some of the most popular instruments traded in the financial markets, including stocks, Forex, commodities, cryptocurrencies, and indices. Each instrument has its unique characteristics, advantages, and risks, making them suitable for different investment styles and objectives. While there is no one-size-fits-all strategy when it comes to investing, understanding the fundamentals of these instruments can help you identify profitable trading opportunities, manage your investment risks, and achieve your financial goals. Always remember, investing in the financial markets involves risks, and it is essential to conduct proper research, seek professional advice, and practice wise risk management strategies. So keep learning, keep growing, and happy trading.